Michael, it's good to see you. I know these things are a moving target. Any updates in literally from today, from the president softening his tone somewhat on the auto front? Maybe there's a deal in the works. The president also just made some comments now, perhaps backing up what Lutnick said, that we're close or done on at least one major trade deal. So does that give you some reason for more optimism?
Well, I do think, yes. The short answer is yes. I think there is a clear signal coming out of the White House that they would like to de-escalate some of the trade tensions that are in markets. And so I think that fits in with our view that just tariffs are too high. They make too much of the trade between the U.S. and China not economically viable. So what the market needs and the economy needs is kind of clear evidence that there's a path to de-escalation. And at least with respect to non-China trade, these indications about deals getting done, whether they're memorandums of understanding or literal deals, is a different question. But I do think it's important for the economy, the business sector, the private sector to see that happening, because right now that's all we really have to go by. Right,
or the shipping data, which I think you guys are also following closely, like what's happening with container ships and imports and freight volumes.
That's right, and that's our narrative at the moment is we are possibly in a race against time, that given, as I said, where tariff levels are, and it makes so much trade just not viable, what we are seeing in the very high frequency shipping data is a collapse in trade volumes. Now that doesn't mean the world is ending today, because those orders can come back on. So maybe you delay a month and then they come out in the next month. But yes, the high frequency shipping data suggests that the trans-Pacific shipping routes have really taken a step back. So, we probably have a window of, let's say, 60 to 90 days where we might hope to get some de-escalation in trade policy in order to allow for a resumption of trade flows. But that's the tension as I see it right now.
What are your expectations for the GDP number Wednesday, for payrolls Friday?
Yeah, look, expect a very weak headline GDP number. We think it'll be around minus 1.4, 1.5%. That's mainly due to the big front loading of imports. You saw the trade data this morning at 27, 28% month-on-month increase in the imports of consumer goods. So big front running of purchases, front running of imports. And the GDP adding up, that's going to drag growth lower.
Did I catch you? Did you say you think we're going to get a minus 1.5% print?
Around minus 1.5% at the headline.
But do you think that's going to startle the markets? I mean, and just so people understand the math, C plus I plus G minus NX. If there's a lot of imports, you get a big drag on GDP. But it's not like it's just mathematical. It's weird. It's like the one benefit that we might get, the front loading of all of this, is going to be a huge GDP drag. And then I don't know if we're expecting a rebound in the quarters to come.
Right. And so you're getting some of the idiosyncrasy in the high frequency GDP data here, which is monthly or quarterly for high frequency on this front, where we're getting a lot of imports. Normally you'd say, hey, those imports are going to be spent or they're going into inventory. So you should get a big offset from inventories. It's just not kind of adding up. But you're right. In the pure GDP math, imports subtract from growth. But there's a way to look at final sales. So if you take GDP and subtract out trade and inventories, which are the volatile items quarter to quarter, that number is 2.5%. So about where the economy's been for quite some time.
Healthy.
So healthy. If you look at that underlying demand number, we expect that one to be fine. Now, on the employment report on Friday, we're a little above consensus at 160,000, but the JOLTS data this morning does give us pause, right? There was a big move lower in job openings in March. I think you'd anticipate probably did that again in April. So the data claims and others don't suggest the firing rate has picked up, but that JOLTS data suggests, hey, maybe the hiring rate really slowed down.
That's a good point. That was in March. That was before,
That's right.
Quote
before
unquote,
Liberation Day.
Yeah.
That's right. So if we took that big of a step down in March, maybe we took another similar sized step down in April, right? And this is the trick from our economist forecasting perspective. We don't really get any revelation of the employment side of things, the hiring rate, until the actual employment report hits. So I do think there's downside risk to our 160 forecast, maybe closer to the consensus number of, say, 135, given a slowdown in the hiring rate.